Hi, this video is the third video of Lecture 1. In this video, I will talk about the goal of the firm and the financial markets. In a corporation, the number of shareholders can be multiple. Shareholders might be different with each other, so they may disagree over the objectives of the firm. In reality, some corporations have board of directors. They vote for the main decisions. After decisions were made, managers try to implement the decisions. So we can see that the process of decision making and implementation is complicated inside a corporation. Then it is very useful to set a unified goal of the firm to guide the decisions. Generally, we think the goal of the firm is to maximize shareholder wealth. Then shareholders can independently decide how to allocate the increased wealth. If a corporation has lower value comparing to similar firms, then the corporation will not be able to survive for long. I want to be more accurate about maximizing shareholder wealth. In business news or talking with business managers, you may have heard maximizing accounting profits or maximizing market share. These targets of management are very similar to maximizing shareholder wealth, but still quite different. We will have deeper discussion about this difference in the synchronized course. Here I provide a simple example. If 3M Corporation is going to change the materials for producing face masks, it will choose the material of low quality and low price. So in the short run, the cost is lower, so the accounting profits is higher. However, in the long run, the customers of 3M products will be aware of the low quality, so they will abandon the products produced by 3M. So then, standing in the viewpoint of shareholders, you may think that the valuation of 3M Corporation is lower after implementation of this material change. This example gives us some intuition about how business decisions need to consider the long-term benefits of shareholders. After we make decisions, we want to implement the decisions. But in the corporation, we know that the owners and managers of corporation can be different. For example, if you have shares of Apple Corporation, you are the owner of Apple Corporation, one of them. But the Apple Corporation is under the management of Tim Cook. Now we want to ask, what if Tim Cook doesn't work in my benefits? This problem is called the agency problem. The managers will put their self-interest ahead of the interest of shareholders. If a corporation has the agency problem, the additional agency costs will lower the value of corporation. Now I'm going to talk the second topic for this video, the financial markets. After the corporation made decisions about real asset investment, it needs cash to implement this investment. Corporation goes to either the capital market or money markets to raise cash to support these operating activities. If the corporation goes to the capital markets, it raises long-term funds. If the corporation promised to pay fixed payments in the future, we call this financing as debt financing. If the corporation promised to pay a share of future profits to investors, then we call it equity financing. Corporation can also go to money markets to raise short-term funds. Clearly, the market situation in capital markets will affect the financing decisions of managers in a corporation. we have two different markets to raise financing, to raise fundings. One is the public market. For example, New York Stock Exchange is a public market for stock. Because general individual investors participate in the public market, they are under strict regulation by the Securities and Exchange Commission. Another choice is to go to some financial institutions, for example, pension funds, hedge funds, and private equity funds. Corporations can directly raise fundings from these financial institutions. We call this as private market. They are also under regulations of SEC, but there might be some difference. For the discussion of this course, we think the analysis of decisions are similar between this public market and private market. When the corporation goes to the financial markets to issue debt or equity, there are two steps. The first step is that the corporation will sell the securities to the initial investors. We call this activity as primary market activity. For example, Zoom went IPO in April 2019. For some corporations, after its IPO, it continued to have equity issuance. We call this activity as season equity offering. The next step occurs in secondary market. We are familiar about New York Stock Exchange or NASDAQ because we can buy and sell the stocks of corporations in these markets. These markets are called the secondary market. The investors, they have subsequent tradings of securities. Secondary markets can be very important for corporations because we have intensive transaction activities in secondary markets. Then we have values from this transaction information. For example, when a financial manager made a new capital budgeting decisions, he will check the response of the secondary markets. If the stock price goes up, it reflects that the market evaluates it is a good decision. In this way, the information from the secondary market transaction activities help the managers. It helped them to make better capital budgeting decisions. I have finished the details of Lecture 1. Now I want to have a brief summary for Lecture 1. In Lecture 1, we talk about the main categories of business organizations. We mainly focus on corporation. We talk about the main decisions of financial management. They are capital budgeting decision and capital structure decision. You may also want to call them investment decision and financing decision. We talk about the asset composition of corporation. We also talk about the goal of the firms is to maximizing shareholder wealth. We also talk about we may have agency problem when the managers doesn't make decisions in the interests of shareholders. We also talk about how managers can use financial markets to support its capital budgeting activity. Here is a useful graph to understand the relationships between the firm and the financial markets. So the firm can go to the financial markets to raise funding. Then the firm use the money to make new investment, for example, construct new plants or launch a new research and development projects. After the real assets generate profits for the firm pay corporate tax. After paying tax, the firm pay the interest payments to the creditor of debt and distribute dividends to the holder of stock. For the remaining cash flows, we call it retained earnings. the return earnings will go back to the current assets of firm. Then firm use this retained earning to have more investment activities in real assets. I hope this course will be helpful for your career planning in finance sector. Students in finance manager in Carson School of Management will have careers in corporate finance, banks, insurance companies, investment banks, consulting firms, and property brokerage business. If you want to have more information about your career planning, you can talk with support from the Undergrad Business Career Center. They provide excellent service for helping you to have good career plan. Thanks.